action is in the broader markets, right? The mid-cap index, the small-cap index, all showing you gains of close to about 3/4 of a percentage point. Very strong advance decline ratio too. That's up close to about 5 stocks advancing for 2 in the red. But let's straight away get to a corporate conversation. AurionPro Solutions reported their Q4 numbers. The company's posted a 30% jump in revenue and a 30% jump in EBITDA too. EBITDA margins have come in at 21.3%. The company says they expect the growth momentum to continue into FY25 and they're guiding for a 30 to 35% revenue growth next year. Ashish Rai, the CEO of AurionPro Solutions, is here with us to take a few questions. Mr. Rai, morning. This is Reema here. First, FY24, you've ended with a growth of 35% at the upper end of your own guided band of 30 to 35%. What makes you confident you will be able to achieve a similar 30 to 35% growth in FY25? Give me 3 reasons, because the guidance that we've heard from some of the larger IT services company seem to suggest that they're still very cautious about the macro environment. So 3 reasons why you will be able to achieve a 30 to 35% top line growth in FY25.
Yeah, good morning, Reema. Thank you for having me. Look, I think so. We don't do IT services, so I won't comment on that, right? I mean, we do pure tech. We do deep tech, we build products based on hard R&D, and we are out to build out a global IP-led products and platforms player that can play in the segments we choose on a global basis. So really, I mean, I can't comment to the IT services demand, but we see an unprecedented demand environment for our offerings, both on the banking side as well as on the technology innovation group, right? So this one, I think demand environment is just exceptionally strong across most of our markets. The pipeline and the order book is at record levels right now, so we feel very good. We've now been growing 30% plus for 3 consecutive years, right? So since we pivoted away from services into building out a products and platforms player almost 4 years back, last 3 years we've grown at 30% plus. We feel good about continuing the growth trajectory. In fact, we listed back in 2005. For the last 19 years, we've grown at 30%, right? So it's not really. If you look at the CAGR, I think we feel very good about where we are. We feel very good about demand, pipeline, execution. So yeah, I think we feel we'll deliver.
Okay. So one significant thing next year is going to be the cash deployment, because you recently raised money via the QIP and the preferential issue, and you've got some marquee investors on board too. So what's the cash balance, and what are you planning to do with the cash book, the cash balance that you have?
Yeah, so look, I think we published the balance sheet at the end of the, so for 31st March, but of course the QIP happened after that, and we raised a further 270 crores, right? So I think we ended 31st March with a balance in the range of, I think, 250, 270 crores, and then the QIP 270 sort of adds to it. We are obviously, we've done almost 3 acquisitions in the last 6 months, so we've been deploying cash in M&A, which is quite clear. We recently, after the year close, we deployed cash in the Arya.ai acquisition that we talked about. And I think going further, some of the capital will go into organic growth because we've been growing at a tearing pace. So there is a lot of organic growth capital to be put into the business, but a fair amount will also continue to go into M&A.
Also just take us through the margin levers at play, along with, of course, the cost side of things, because you've ended the year, annual basis, margins are just under the 22% mark. As we roll forward in this year, do you see levers at your disposal where perhaps you can breach the limit of 22% as well, EBITDA margin?
Yeah, so the nature of the software business is such that with scale, the economics does improve, right? So which we've been saying, but what we also been doing is most of the R&D that we've been doing, we've been expensing out, we don't capitalize it. So the communication we've had with investors for the last 3 years, pretty much, most of my earnings call, I say the same thing. We will try to keep the EBITDA at about 22% levels, between 20 and 22, and we'll pour the excess back into R&D because, the size of opportunity in front of us is so large that we will really not be doing the AurionPro shareholder justice if we do not keep on upping the R&D spend every year. So we will, up it to almost 100 crores plus this year. Right, so that's sort of the play on R&D. The EBITDA, actually, if you look at it, we also had an ESOP cost for the first time hitting us last year. And that's probably of the order of about 1.2% or 1.3%, right? So if we did not have that, that's not a cash expense, of course, but obviously it hits the P&L. Otherwise, the EBITDA would probably have been 23 plus.
So continued investments in R&D. Therefore, your guidance, you're going to stick to the upper cap of 22% as of now. Okay, got that. Just take us through some of the fundraising plans as well. Reema was earlier telling us that the preference issue plus the QIP, I think the total comes to about 570 odd crores. So what are your plans with the money? Would you be needing to raise any more in this year?
Yeah, so we don't look as a business, we don't really need capital to keep growing organically the way we are going. I think we spin off enough excess capital to invest back into the enterprise. So we were trying to create a global player which can, our stated vision 2030 is to be a top 3 player globally in each of our spaces. That is a very, very large goal to go after, which means we will find gaps in our strategic blueprint, which means we will sometimes decide to do an M&A to plug that gap instead of building it ourselves, right? So every single opportunity that we build against every single gap, you have always a buy versus build choice. And sometimes we find like-minded management teams. Sometimes we find, the right kind of assets available at the right valuation. And then we do that M&A. So I think we'll continue to do that to continue to grow at our pace. I think we probably added 35-40% staff over the last 12-14 months. Right, so that also needs a lot more, capital going into the fixed assets.
So Ashish, sorry, since you brought up M&A and you're still open to more strategic opportunities, A, is there anything on the table right now? And B, when we just discussed the top line growth trends, the 30-35% growth that you're talking about, that's purely inorganic, right? That's not taking into account any of these strategic options that you're also exploring?
Yeah. So I think the 30-odd% we will continue to grow organically. I think the order book is strong enough and the pipeline is strong enough. The only thing we need to do is continue to scale the delivery capacity to be able to do that, and that needs some investments into the enterprise, right? So we don't need to do M&A to continue to grow at that level, but just to speed the time to market in terms of the products we want out, in terms of what the market needs. For example, the whole AI. Enterprise AI play that we are building out, we will find opportunity to do some meaningful M&A, and we always have a pipeline of potential targets. But we have zero FOMO when it comes to deal making. It only when it really makes sense for the AurionPro shareholder, and it really.
So Ashish, if there is no pressing need to do an M&A right now, why is it that you've raised so much money then? Because there is opportunity, right? Reema, I think the idea is not whether you need the capital to continue to grow organically. I think the idea is how do you capitalize on the really large opportunity in front of you, right? So whether it is in lending, whether it is in transaction banking, we've built out tier 1 assets which can really go and play globally. Right, and then so the idea is not can you keep on growing at 30%. So So is it possible that you will do an acquisition to capture the large opportunity in front of you in FY25? Is that likely?
Certainly possible. Both from a product standpoint as well as from a market access standpoint, because we're very serious about being in US and Europe, right? So it's always possible that we find the right opportunity.
Okay, Ashish, thank you very much for that. We had more questions for you, but for now, we're going to take that the company is confident about growing at 30 to 35% over the medium term, not just in FY25. They've been holding on to this growth rate for the last many years, and that's going to continue. And margins too will stick closer to 20 to 22%.
Okay, let's take that quick break. We'll come back on the other side.